From New York City, for our viewers worldwide, a very good morning. I'm Manus Cranny in for Jonathan Ferro. Do you have pre-stage Nvidia nerves? These equity markets do ahead of those numbers tomorrow. Let's see how we go down as we count down to the market open. It begins right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Coming up on the show, markets on edge as traders start questioning the Fed's next move. Earnings season failing to move the needle, with Nvidia angst up next. And it's the biggest deal of 2024. Capital One agrees to buy Discover for $35 billion. But we begin with that big issue. Is the consumer starting to crack?
The consumer has been trading down. I mean, we do continue to see that. And I think Walmart's strength reflects some of that. It doesn't mean it's all bad for the consumer out there. I do think that the consumer is choiceful, as Walmart said, and it has been able to spend where needed.
Walmart topping the earnings estimates, but delivering a relatively subdued outlook. Home Depot posts the fifth consecutive decline in quarterly sales. So what does it all mean for the consumer and for markets? Let's bring in my guest this morning to join the conversation, BlackRock's Tony DeSpirito and Sonal Desai from Franklin Templeton. Good to have you with us. Two huge reports, which in some ways tell us a little bit about how the consumer feels right now. Tony, good morning. The language used in the report from Walmart strikes a restrained kind of tone. First take?
Yeah, so look, I think if you look at the economy has been very strong and even maybe accelerating. If you look at fourth quarter GDP or if you look at GDP now estimates for the first quarter this year. So I would say the economy is good. Then you look at jobs. Unemployment's 3.7%. That's really good. And then you look at wages. Wages are also been very strong. So I think broadly the U.S. consumer is still in very good shape. Now, there are a few yellow flags that would think of us maybe having a little bit of a slowdown here. You know, if you just look at consumer savings rates, they are low relative to history. The consumer savings rate last report was 3.7%. I would think of something a little bit north of 6 as more normal. So you would expect it to slow down a bit, but I think the consumer is still really strong, and any worries about the U.S. consumer are misplaced.
Yeah, UBS's favorite phrase, don't ever bet against the hedonism of the U.S. consumer. Sonal, good morning to you. Good to see you. In terms of the takeaways for the bond fixed income investor from an equity report, it's always hard to discern. But in terms of that cautiousness from the consumer, it could be an indicative to pricing and to that disinflation narrative.
So I think that the real thing here to think about is that the disinflation narrative got ahead of itself. I've always said, the move from 9 to 4 was going to be a lot easier than from 4 to 2. And I think we're kind of stuck where we are. So it's less about the bond market. You know, if I look at 10-year yields, I don't think 10-year yields are ahead of themselves. What was ahead of itself, in a sense, was the pricing of Fed rate cuts, which I think had gone way too far. And on balance, I would say equally overdone are the new fears that the Fed is going to hike next. I do think that it's in line with the idea that rate cuts get pushed into the second half of the year. And on balance, the Fed may choose to go 50 instead of 75.
Okay, well, let's dig a little bit deeper into these two reports. We've got Katie Greifeld alongside me. We've got the retail earnings rolling out. Mixed results, Walmart and Home Depot this morning. Katie Greifeld joins me on breaking those numbers down. So, Katie, what is the language here? They are being choiceful at Walmart in the aisles.
Choosy when it comes to Walmart, and you actually see shares quite higher, even though it did come out with that language. Take a look at Home Depot. It's down in the wake of these results. So let's start with the bad news. Let's start with Home Depot, because that is a fifth quarter of comp sale declines that we learned for Home Depot in this report. Specifically, comp sales fell 3.5% in the fourth quarter, but Home Depot said it also expects a 1% drop in comp sales for the entire year. That is what is dragging down the stock right now. So that downbeat forecast, less like most things at the moment, Manus, that comes down to higher interest rates, mortgage rates in Home Depot's case. They're still very high. That is weighing on home sales and new construction. As a result, demand for home improvement. A different story over at Walmart, like I mentioned. It actually topped estimates. It did deliver soft guidance for the current fiscal year, as you said, citing those selective spenders. But the CFO was quick to point out that Walmart is gaining share in nearly every category, perhaps, of course, as consumers trade down. Walmart also said it's buying smart TV maker Vizio for about $2.3 billion just to top things off. So that's the setup as we really head into the heart of retail earnings.
Yeah, it is a Goliath, isn't it? Just captures everything on the way up and on the way down. You're just riding those waves like pure surf. Katie, thank you very much. My guests this morning are Tony DeSpirito and Sonal Desai. They join me to discuss where we are. I look at last week, I look at the beginning of this week, and I look at the three incidences that took place. PPI, CPI, or chronologically CPI, PPI, and University of Michigan, which UBS, I had them with me this morning. Michigan consumer sentiment data is entertainment and not substance. We can debate that in a moment. The backup in yields, Sonal, good morning. Where are we? Do we go into some kind of suspended animation on inflation and rates in this medium term? Sonal.
So, I have been calling for a higher neutral rate for quite a while. I think the neutral rate for the US is closer to 4 than to 2.25, which is what the Fed has been calling for and what markets anticipate. And I would just say, if neutral is at around 4, with Fed funds at 5.25 to 5.5, sure, we're restrictive, but we're not as restrictive as potentially we would be if we thought neutral was at 2. Now, this matters because it just means that you will get a more drawn-out return to that 2% target. It doesn't mean that the Fed has to jump right back into a hiking cycle. It just means you delay that cutting cycle. And if I look at the real economy is in a good place to maintain this level of rates. Sure, it's not fantastic. I see that. You see that in Home Depot's earnings, you see that in mortgage rates, all of the above. But the reality is the economy is not tanking here.
No.
So do we go to suspended animation 4.25 to 4.5 for 10 years? I think that's not a bad place for 10 years to land.
Do you think you're slightly on the right-hand tail risk there of assessing where the neutral rate is at 4?
Oh, I think I'm way out there at 4.
I was trying to be gracious and sort of not very confrontational.
But I think it is way out there. But here's the thing. Think about where we're coming from. You look at productivity. If we see productivity over the last 9 months, it's picked up quite substantially. If you actually look at where neutral, did I say neutral real rates? I said 4% nominal.
4% nominal, excuse me.
Yes, but real rates, if I look at where Fed funds neutral real rates were from the 1950s all the way until the global financial crisis, we really were looking at 2.5, yeah? So if you think about inflation at 2, and you think that real rates actually need to be closer to where they were historically prior to the global financial crisis and the flooding of markets with liquidity, it doesn't take a lot to get you up to 4.
No, it does not. It does not.
And I think it's reasonable. If you think productivity has picked up, which actually does appear to be happening, if this is that final pickup in productivity, that would also argue for higher neutral rates.
Tony, where do you come in on this debate, and how important is it for the equity narrative for you to continue to deploy, given what we've just heard Sonal put forward in terms of the neutral rate?
Sure. So from an equity perspective, the way we look at it is there's earnings on the top, on the numerator, and then the denominator is essentially the risk-free rate. And that's your calculation of what the S&P 500 is worth. And a couple of things. One is I looked at the economy, and again, I think the economy has proven amazing resilience. Mm-hmm. Inflation's coming down. Yeah, we saw a little bit of a blip up in January, but I don't think that's an inflection point. I don't think that's a change in the direction of travel. And so I think the economy is healthy. So that probably means good things for earnings growth. And you're seeing companies be really aggressive in terms of right-sizing, extracting operational efficiencies, et cetera. So I see earnings as fairly healthy. And then when it comes to discount rates, I accept the 10-year Treasury where it is. And when I look at it on that basis, stocks look pretty decent to me. The other thing I would comment is if when you look at the S&P 500, while that P multiple looks high relative to historical averages, the S&P 500 has also become a lot more of a growth index over time as it's dominated by the Magnificent Seven. And so you really need to look at the equally weighted S&P 500, which is at a discount of about 23, 24% versus the S&P 500. Its multiple is only about 17 times, looks much more in line with historical averages. So I look at rates and I think where we are is just fine.
Okay, you've both touched on the seminal theme, which is productivity. We're trying to work out what AI will do for productivity. None of us know. And anybody who comes on this TV show and tries to say that they understand what that's going to impact be, I would question them aggressively. But Tony, to you, you said we need to be nimble to know where the opportunity is at a given stage of the progress, makes investing in Gen AI very much an active pursuit. And this is as Gen AI itself sharpens, smartens, and evolves. We have Nvidia angst this morning. We've had it for about 5 days or so. We're getting ready for Nvidia. But when you look at nimbleness within AI and within tech, can you just shine a light on that? What does that really mean for investors?
Well, I have two comments. One's about the tech indices and about indices broadly, and then the other comments about the evolution of AI. In terms of the indices, what we're seeing is more and more concentration in the indices. And if you look at the academic literature on diversification, some of these indexes are becoming less and less diversified. I'll take the world tech benchmark, so not just a US, a world tech benchmark. 3 companies account for about 45% of the weight in the benchmark. No one would call that a diversified portfolio. So I think in some of these areas, active management is becoming increasingly important as the indices become increasingly skewed. So that's a general comment on active management. I think in technology, active is particularly important. You know, we think about AI in terms of a tech stack, right? And at the bottom layer of that tech stack is the hardware, the chips, the servers, et cetera. And that's where all the attention is right now. That's largely well known. What's more interesting is as you move up the tech stack to the software layer, and ultimately to the data layer, that's where it gets really interesting. And so I think some of the most interesting investments we in BlackRock and fundamental equities are making today are at that data level. Companies that have their own unique proprietary data sets, where those data sets, you know, they're valuable today, but they become even more valuable with AI. The data becomes more productive, more valuable, and these companies can price up for it. So what we're doing is kind of moving up along that tech stack from the hardware layer to the software layer, ultimately to the data layer itself. And that requires real fundamental research.
And that's where value evolves over time rather than just a 200% return on equity in the space of a month and a half. Tony, stay with us, Sonal. Great to have you with me this morning. My guests on the markets. Let's get across to Abigail Doolittle. She's side by side with me, looking ahead of the opening bell. What have we got, Abby?
Well, we may have the futures lower at this point, Manus, but we do have at least one stock that is soaring. And of course, I'm talking about Discover Financial, up at this point up 12.4% on the news that Capital One has agreed to buy them for $35 billion. The biggest deal of the year that brings together 2 of the biggest credit card companies to compete with some of the huge money center banks. Walmart up nearly 5%, heading to a record high on the open. Strong quarter, same store sales of 4% were better than the 3.1% estimate. And of course, it was confirmed that they are buying the TV maker Vizio. And then Home Depot down 2.3%, as Katie was talking about earlier, the 5th straight quarter of comp sales declining. In this case, down 3.5%. Some analysts are saying the guidance is underwhelming. And apparently, high mortgage rates are impacting DIY demand. And well, we have those shares down 2.4%, a big contrast to the gain that we're seeing for Walmart.
I got to get myself back to Home Depot, pick up a little bit of extra kit. Abby, thank you very much. Abigail Doolittle there. Coming up on the show, the Fed officials, guess what? They're pushing back.
To finish the job will take fortitude. We will need to resist the temptation to act quickly when patience is needed.
The Fed staying on message there, urging patience ahead of another busy slate of Fed speak. That conversation next on Bloomberg.
finish the job will take fortitude. We will need to resist the temptation to act quickly when patience is needed and be prepared to respond agilely as the economy evolves.
Fortitude, that's what you need. Fed officials continuing to push back, urging patience on the hotter than expected data, fueling concerns that the Fed could soon reverse course.
I think that May is odds off at this point and probably should be odds off. And gosh, I think we've got to recognize what no one's talking about. There's a meaningful chance, maybe it's 15%, that the next move is going to be upwards in rates, not downwards in rates.
That was the former Treasury Secretary Larry Summers discussing the current state of play, setting the stage for another busy slate of Fed speak. Mike McKee is with me, so we get minutes and Fed speak. How much of a Shakespearean clack can I expect this week?
I don't think you're going to get that much, and I'll tell you why. Let's, as Larry said, set up where we are and where we have been. Take a look at the yield curve. January 15th, Governor Chris Waller came out and said, we can cut rates this year, but we're going to have to be measured and slow. Since that date, look what's happened to the yield curve. The white line is today. We've gone up across the curve in everything. Now, will the Fed say anything this week to change that? It's a very light week for economic data. Basically, the only thing that's going to matter to the markets is jobless claims on Thursday. And we get Fed minutes tomorrow, which may or may not tell us something about when they're thinking about cutting, because it's been 3 weeks since that last meeting. Thursday, we also get a ton of Fed speak. You saw the calendar there. But does any of that matter? Because on March 6th, Jay Powell goes to Capitol Hill for his twice yearly, formerly known as Humphrey Hawkins testimony. And that'll really set the market up for what's going to happen. What does the market think is going to happen? Well, as you saw from the change in the yield curve, we've had quite a change in belief about when the Fed might move. Right now, we're looking, if you look over the whole year, at about a 23% chance of a 50 basis point move, a 23% chance of a 75 basis point move. And look at what's all the way over on the end there, Manus. That's the 6% chance that is now being priced into the markets of a rate hike, probably because of Larry Summers. And maybe this is something that Larry did to distract people from the beard that he has grown. Bill Dudley, the former New York Fed president, has a more natural explanation for what the Fed might be looking at out there. And he thinks that the neutral rate has gotten higher because the economy's gotten stronger. And that means the Fed will cut less. If you look at what the one projection for the neutral rate is and where the Fed is, you can see that right now 125 basis points is the most that would project for a cut. So everybody will be looking for clues this week to where we are on that total yield curve, forward-looking. What are we going to do next?
Okay, Mike, thank you very much. Beautifully put, Mike McKee there. Tony DeSpirito, Sonal Desai are my guests this morning. Sonal, would you be a buyer of the tail risk of a 6% possibility of a hike? Would you be a buyer at all of another hike? I know, but I'm just throwing it out there. Go on.
Tail risk, sure. I'd say it's a tail risk, but honestly, there are many things that are tail risks. There's a tail risk that you get 200 basis points of cuts, right? And I think both are not very likely at all.
Okay. You would also say, look, it's hardly surprising disinflation has stalled. The supply side has improved. Take out the Red Sea for the moment. That could be the spoiler alert in all of this. But you're more focused on the demand side, and it is that robust demand side that you're flying the flag for, isn't it?
It is, because, we periodically in the market come back to talking about fiscal policy, then we stop talking about fiscal policy. But the reality is fiscal policy is alive and well and continues to stimulate the economy. And I think that's something which is important. Wages are doing quite well. When I spoke about productivity earlier, by the way, I was not talking about generative AI. I was talking about the last 10 years of CapEx, which has just simply not shown up in productivity. We might finally be seeing that, as we did in the early 2000s when we saw the the impact of the internet boom in the 1990s and 2000s. So my view here is really that the economy, if anything, is in fairly rude good health. It's tolerating the higher interest rates. That in and of itself is an indication that the neutral rate is higher. In turn, it means that the Fed has the luxury of waiting. Why would they cut when they don't need to?
Indeed. Well, as Mary Daly just said, you need fortitude, you need patience, and they need confidence. Let me bring that back to you in terms of the equity side. UBS have upped their guidance for this year, Tony, to 50. Let me just double check. UBS has gone to 5,400. Goldman Sachs has gone to 5,200. So, I mean, these are not huge uplifts, but they are quite significant qualifications to the bullish scenario on earnings. Would you share this level of bullishness?
So one of the positives that we've seen is if you look at estimates for 2024, there's a natural pattern of how estimates evolve over the course of the year. They kind of usually start high and then come down over time. And what we're seeing is they're coming down less than normal, less than average. And so that tells us that corporate expectations for earnings and guidance that we're getting is for 2024 in general is quite robust. And so that's the real positive, and ultimately that's the positive driver for equity markets.
Okay, well, they're going for $240 this year, up from 235. So they're going for a high single-digit increase in earnings. Thank you so much for joining me, and well done, Sonal. As you say, I can throw any tail risk in there, and there's plenty of them. A 200 basis point cut in there as well. Tony, thank you very much. Tony DeSpirito, Sonal Desai, keeping it real on the tail risk. Coming up, your morning calls. We have Joanne Feeney a little bit later on. Advisors Capital Management joining me for the conversation on the tech moment we're facing in the next 24 hours. It is a make or break moment for sentiment, is it? This is Bloomberg. Time for your morning calls. You nervous ahead of the Nvidia results? Counting down. This is what we got for you. Deutsche Bank upgrades JetBlue to a buy, pointing to improving domestic supply backdrop. Next up, Evercore downgrading Caterpillar to in line, recommending investors start taking your profits on sectors that have had a outperformance recently. And finally, Bank of America downgrades AIG to neutral, expecting a challenging year ahead of margins and top-line revenue growth. Coming up, Feeney of Advisors Capital. See, eventually football comes home to America. Major League Soccer, they're looking happy over at the NASDAQ. Not so happy on the stock front. You got Tesla and Nvidia. There is Nvidia angst. It's going to be a big swing factor, according to Mr. Emmanuel over at Barclays, ending up to 10-15%. If they don't fill on the nail with the numbers, it could drag these markets lower. We're lower on tech, but there are outstanders. We'll bring that to you. There is the opening bell. Equity markets are set to open a little bit lower after President's Day. So that's the state of play there. We've had this jolt in yields on Friday, looking at the highest level that we've seen in 2024. You're looking at a 10-year paper this morning, giving a tick or two back. Euro dollar, this is the euro up by 0.5%. And you have crude trading up 0.7% at 79.77. So a little bit of an ad there on the oil market. Two stocks to watch. It's all about the deals that have been announced. Capital One and Discover Financial. Capital One agreeing to buy Discover for $35 billion, creating the largest U.S. credit card company by loan volume. Abigail Doolittle has the details. How is the market taking this, Abby? Good morning.
Good morning. And Discover holders are very happy about this. The stock right now about 12%. Its best day since November of 2020. For Capital One, not so much, but that's not so surprising given the fact that when a company acquires another company, you will often see those shares shrink. So in the case of Capital One today, down nearly 5%. Relative to the potential deal, as you mentioned, Capital One has agreed to buy Discover Financial for $35 billion. Discover shareholders will receive a little more than than one share of Capital One. That represents a 26.6% premium. You can see, though, that the Discover share is up about 11%. That suggests that investors and analysts, market forces believe that there could be some reason that this deal doesn't happen. Now, I could take a guess that that could be the FTC or regulatory hurdles and the terms of fears around some sort of a monopoly. We don't know that's the case, but that is a very, very wide spread between the big gain that we do see Discover having and the premium that was offered. Now, as you mentioned, the combined entity and the reason for the deal on the part of Capital One is to be the biggest credit card lender. Their assets together would be above $250 billion. Take Citi and JP Morgan, the next largest, both around or below $200 billion. As for Discover, well, this gives them a way out of some of their legal overhang and what some analysts are calling a weak 2024 outlook, Manus.
Well, it's going to create a behemoth, isn't it, in terms of the credit card data, information and size. Abby, thank you very much. Abigail Doolittle. Let's turn our attention to the chips. I mentioned Intel in the opening calls. It's in talks with the Biden administration to give more than $10 billion in subsidies to the chip maker. That's according to Bloomberg reporting. Simone Foxman has the Bloomberg scoop.
Yeah, Manus, sources telling Bloomberg that this is going to split, but we're not quite sure how it's going to split between the $39 billion that the Commerce Department has earmarked in grants and the $75 billion that they've earmarked in loans. According to our sources, these negotiations are ongoing, but we could get an announcement in the coming weeks. Citi, in a research note this morning, speculates that we actually could get it tomorrow. Tomorrow is Intel's Global Foundry Day. U.S. Commerce Secretary Gina Raimondo is expected to speak there. One of the other things likely helping Intel this morning is an announcement that Global Foundries will also receive grants, $1.5 billion in grants, $1.6 billion in loans as part of these CHIPS Act programs. Now, Global Foundries is going to ramp up its manufacturing in New York and Vermont. Intel has enormous plans, much bigger plans to do so across the country, a $20 billion factory in Ohio. That would be the world's largest $20 billion expansion in Arizona and $3.5 billion investment in New Mexico among its plans. That said, it has struggled to keep pace with rivals, especially TSMC. And Citi says Intel is still far behind in the tech. And ultimately, despite all these grants and loans that it may get, it's going to be extremely difficult to battle TSMC. However, you have CITIC also initiating a coverage with a buy at $55 a share. The news eliminating some of the losses that Intel has felt this year, though the share is still down over 10%, Manus.
Okay, Simone, thank you very much with the very latest on the chips in the globe and the Inflation Act and how it is being deployed. Let's get back to the earnings, and it's a tale of two retailers. As we've been saying, Walmart jumping on better than expected results. Home Depot under pressure after posting a fifth consecutive decline in quarterly sales. Katie Greifeld is side by side with me this morning. I mean, this is about Walmart's power and influence and the reality of a post-COVID change of the amount of DIY we're doing.
Exactly. I mean, Walmart, it really had a strong quarter. It topped estimates. It did, though, deliver weak guidance when it comes to the current fiscal quarter, though the CFO was quick to brush that aside. He said that consumers, they're being choiceful. They continue to spend less per trip, but they have been shopping frequently, and of course pointing out that Walmart, it's gaining share in nearly every category. So like you say, still very dominant here, dominant in the stock market this morning as well, up over 5%. It's a different story when it comes to Home Depot. We were talking about the fifth quarter of comp sales declines for Home Depot. To get into the numbers here, comp sales fell 3.5% in the fourth quarter. That is slightly better than expectations, but again, that's a size and scope there. And then you look at their forecast for the full year, and that actually they're expecting a 1% drop in comp sales. Analysts had actually been looking for a 0.2% improvement, so a disappointment there. And as we were talking about just a few minutes ago, of course, that comes back to high mortgage rates that has pretty much frozen the housing markets. Even though you have seen mortgage rates come down a little bit, they're still very high, and that means there's less demand for home improvement, which Home Depot, that's their bread and butter. So that's the setup. Again, Manus, you can see Home Depot shares currently about 1% lower.
Okay, I'm off to Home Depot for the hard hat and the tool belt. Katie, thank you very much. Joining me now to talk about the consumer is Joanne Feeney, partner and portfolio manager over Advisors Capital Management. Joanne, good to have you with me. Very different stories, aren't they? Walmart to Home Depot, Walmart size and breadth. It is so so significant. But they talk about a caution in the consumer. You don't want to overemphasize that, but do you take anything away from that cautionary tone about how the Walmart consumer is behaving?
Yeah, Magnus, I think we've seen that from a lot of companies this earnings season, and it's not surprising. I mean, you have to look at the consumer as not one generic consumer, right? We have consumers at different points and places in the income distribution, and those folks that are down at the lower end of the distribution or even the middle range have been having to deal with these higher prices. And so, yeah, they're going to be more selective about where they spend their money. And Walmart related that. We own Walmart in places. We also own TJ Maxx and Target because we see that dynamic continuing to play out. But overall, we have more people employed than we've had ever. They're making good wages. Their real disposable personal income has been rising. So overall spending from the consumer remains quite strong.
Yeah, I mean, as you say, we're sub 4% employment numbers. We haven't had that in decades. You talk about, though, confusion in the economy. The Fed is talking about wanting more confidence about cutting rates. What is the most confusing aspect of the economy? Because wages are strong, jobs are plentiful, disinflation is taking place, maybe not as fast as everybody had estimated. But what is the most confusing part for you?
Yeah, Magnus, I put out a commentary this morning about this because, you listen to earnings calls and some companies say, hey, the macro economy is challenging, demand is weak. Other companies are saying, hey, strong 2023, we expect another strong year in 2024. So what gives? I mean, if the economy is strong, why isn't everybody saying that? And if the economy is heading towards recession, why isn't everybody warning us? And we're seeing a mixture of information out there. And the reason is because different parts of the economy are in different parts of the business cycle. So some companies, like in the chip industry, some of those companies are saying, hey, we've had our customers already build up their inventory. They don't need more right now. They're cutting their orders. While other companies in the chip industry, like, say, an AMD or Nvidia, are seeing continued strength in demand because data centers are building out this new AI capability. So you really have to parse the data, look at individual companies and see where they are in their business cycles. And then, of course, our view is you invest for the long term. Try to work through these cycles and stay with quality companies.
I'm looking at the news flow this morning. It's about Intel potentially getting $10 billion of a grant, Global Foundries perhaps a tenth of that. Now, a lot of this is obviously wrapped around the Biden administration's policy. This is about protecting America. It's about technology independence. It is about onshoring, friendshoring, if you want to call it. It's any myriad of those things. When you see this kind of subsidy coming through to the likes of Intel and Global Foundries, does that set a stronger argument for these stocks relative to Nvidia? Do you have to look beyond Nvidia? And if so, in the chip space, where do you do that?
Yeah, Magnus, I mean, clearly these subsidies are going to help around the margins on the depreciation costs that these companies ultimately will record down the line. It'll be less expensive to build these new factories. And so that'll pass through to profits. And you're right, and that's not going to help an Nvidia that doesn't have its own manufacturing capabilities. But when you look at the long-term investing opportunity, that is one factor. It's not just Intel that's going to receive these benefits. We saw Global Foundries, but in addition, Texas Instruments, Microchip, other, perhaps less flashy U.S. semiconductor designers and producers are also standing to benefit. And so on the margin, it's going to help their profitability. But overall, when you're looking to assemble a portfolio with some exposure to technology, you want to look also for the secular growth in their end markets. And in semiconductors, it's a pretty good opportunity because content, that is the number of chips in everything, from consumer products to industrials to autos, is rising. And that content points to a long-term secular growth opportunity. So there's a lot to choose from out there. You have to just figure out what your horizon is for investing, your risk tolerance, because obviously an Nvidia is quite different from a Texas Instruments.
Well, let's just pause and think about those earnings because they're coming down in the next 24 hours. So the Nvidia results, they'll come after the closing bell tomorrow, and it could have major implications across the risk and the proclivity for risk globally. Alex Webb is with me. Alex, what am I going to be focused on this result set?
As ever, the forecast is the going to be front and center. The market is looking for revenue in the order of $22 billion. That would be compared to the $20.4 billion that they're expecting for the quarter that just ended. Let's put that in some context. The company itself is forecasting for this quarter that we'll see the results for of 20 billion plus or minus 2%. The market therefore is expecting the very top of that, the 20.4. It does mean that if there's any, in order to meet expectations, they probably kind of have to beat expectations. Anything less than that, given the scale of the expectations, is likely to be disappointing. Sometimes though, it's easy to think that the expectations are so sky high that you can't possibly meet them. It's important to remember that Nvidia is trading at about 35 times its forward earnings, and that isn't actually massively outside of the realms of what some of its peers are doing. In fact, AMD is trading at a far higher multiple. Microsoft is also trading at about 33 times its forward earnings. So yes, expectations are high, but they're not unrealistic.
Okay, let's take that thought back to my guest this morning, to Joanne Feeney. Joanne, when you hear that kind of comparison on multiples, do you still feel brave to step in? How defining a moment for risk for 2024 will these Nvidia results be tomorrow?
I don't think the Nvidia results will be all that informative about risk. I mean, clearly Nvidia is in the middle of a investment stage for generative AI. We're seeing those capabilities be built, and those are expensive. Lots of chips are required. In fact, it looks still like Nvidia is constrained on how many chips they can sell into the market because of production limitations, packaging limitations, et cetera. So, whether they beat or miss or guide to where the investors expect they will is an incremental piece of information, unless they say something like, oh, sorry, we thought there was going to be demand, but it has suddenly evaporated. We don't see that as a possibility. And that would really be the only significant information. So I suspect, they're going to either beat or meet expectations, but it's really largely going to do with their capacity of their partners to produce the chips for NVIDIA. And so that's not so informative. What we really care about is the long-term potential of generative AI and how quickly companies want to create the capacity to run these new models, the large language models and other applications that we're just beginning to see. It looks to us like there's a really long runway ahead and that we're just getting started on the applications that are going to be rolled out. Look to the software companies for other places to get information about the uptake of AI.
It seems as if we spend an inordinate amount and an outsized amount of time talking about NVIDIA as if there's nothing else. But you also make it very clear that if you pay attention to the earnings calls, specifically within tech, and whether that's Texas Instruments or whether that is Cisco, you are a buyer of fissures. Perhaps if you listen to the calls, you want to take advantage of them. Why Texas? Why Cisco? Briefly.
Yeah, both of those recently had what some would call weak earnings reports, weak guidance, and they're in a cyclical inventory correction among their customers, and so their guidance wasn't particularly strong. They're citing a slowdown in demand from their industrial customers, from some of their enterprise customers, and that's often a good time to buy these companies because overall, the long term is very, very encouraging. More semiconductor content, more communications network infrastructure is going to be required over the next 5 to 10 years. And these are two very well companies, pay a dividend, a good place to be for the longer term.
Okay, Joanne, thank you so much for being with us there. Joanne Feeney, my guest on all things tech and market risk. Coming up on the show, it is the biggest deal of 2024.
Companies are looking for opportunities to expand, to acquire innovation and new technologies, developments. That's a fairly normal thing given the structural cycle that we are in.
Capital One agrees to buy Discover for $35 billion. The deal in conversation, that's ahead on Bloomberg.
This is Bloomberg The Open. I'm Abigail Doolittle. You're looking at a live shot of the principal room. Coming up, Tillman Fertitta, the owner of the Houston Rockets. This is Bloomberg.
companies are looking for opportunities to expand, to acquire innovation and new technologies, developments. That's a fairly normal thing given the structural cycle that we are in. We're not in the sort of frenzy of M&A that we've seen in the past, but that I think is also logical because we're in a more normalized interest rate environment now.
So the deal is in. Capital One agrees to buy Discover Financial. Price tag, $35 billion, creating the largest US credit card company by loan volume and opening the door to greater competition against other giants on Wall Street. The transaction is expected to close later this year or early next, pending regulatory and shareholder approvals. Shonali Basak is with me now. Shonali, I'm looking at Capital One. There's dissent in the ranks. Have they overpaid? Have they overreached? What have you got?
One interesting example that we've been given here by Bloomberg Opinion's Chris Hughes is that if they had waited to buy Capital One here, for Capital One to buy Discover shareholders get 40% of the combined company. Had they not waited, had they done this before Discover hit some of its regulatory issues, they would have had 50% of the company. So you do have a discount here to some degree that Capital One is getting to buy Discover. But remember, there are a lot of questions still about this deal. This would be one of the largest deals, Manus, since the financial crisis in financial services. And you do have here a number of regulatory matters that Discover has been contending to, hiring hundreds of people to meet those regulatory concerns. And then there's the matter of antitrust and how regulators will look at the deal that would combine two of the top 6 companies by credit card loan volumes in the United States, let alone the globe, really, here. So what you have is really the case that Capital One is making, that it would add for them a network. Remember, it's an issuer that you're seeing primarily in Capital One. It is a diversifying business to add a network the size of Discover. And therefore, you have a different company, even though 1 and 2 make, or 3 and 6 in this case, rather, make number 1 in terms of loan values in itself.
So where are we on the M&A? I mean, we saw some pretty big deals go through on the oil majors, and that's about integration in the Permian. Here we are, the first major financial deal which has not been pushed through because of angst in the market. How does it set the stage for 2024 then, Shonali?
You have to understand that by this deal and the deal you're seeing for Walmart in itself, you have deal volumes up about 55% from when they were last year. And part of that is not only the market starting to find some ease in itself, you also see divergence in major players here, valuations starting to find a floor in which it is appropriate for those larger companies to buy ones that have been left behind. And then there's that regulatory certainty, Manus. When you think about even just Capital One, for example, it comes after the OCC and the DOJ have outlined new guidelines for mergers. The Federal Reserve stress test scenarios have come out. There is a sense of clarity here for major acquirers to come out in a way they have not in the past year. And another fun fact for you, the deal advisors, more boutiques on this deal. The deal fees are going to smaller banks in this environment. And so let's see if that plays out through the remainder of 2024.
Okay, well, we certainly know that those investment banking teams are beefing up for a pretty good year of deals. Let's see if it plays out. Shonali, thank you very much. On the latest with the deal flow. Some price action, sector price action this morning. Let's get back to Abigail Doolittle.
We're looking at some weak action, not just for sectors, but overall. The Nasdaq 100 down more than 1%. The S&P 500 right now down more than 0.6%. From a composition standpoint, yes, weakness there too, because we have more sectors that are down than not. Starting off with tech and consumer discretionary. We also have communication services. Speaking of the financials, among the worst, but it's really discretionary and technology, both down more than 1%. We'll be taking a look at a piece of that in a moment. But those are those heavyweight sectors, so really weighing. To the upside, we have the 3 defensive sectors, basically consumer staples, utilities, and healthcare. So the fact that you have those 3 defensive sectors higher is risk off, because it tells you which way investors are leaning. As for that heaviness for tech, well, a lot of it has to do with what you were talking about earlier, and that is Nvidia and fear around it. The valuation has that stock on too far right now, down sharply, weighing on the chip index. You can see over the last 6 days, it is down 5 of those 6 days, and overall down 3.4%. Not a great way for these stocks to trade into that report tomorrow, Manus.
Yeah, but as we've heard, the valuation on that stock is not that stretched relative to some of the others in the peer and in the sector. Abby, thank you very much for breaking it down this Tuesday morning. Coming up in the show, market moving events. We're building up to Fed Speak and Fed Minutes. I'll give you your trading diary in just a moment. Punchy drop on stocks this morning. They're nervous on Nvidia. That's what's dragging the Nasdaq lower. And of course, this Fed, it could be a little bit restrained in terms of the action on rate cuts. Your trading diary, we're counting down to the Nvidia report card tomorrow. Plus, we'll get the Fed minutes. Thursday, we've got the US PMIs and another round of jobless claims. Some people are saying they are the most important numbers every week. Fed Speak, Jefferson, Bowman, Harker, Cook, Kashkari, Waller all follow the minutes. And Friday, Warner Brothers Discovery Report. This is Bloomberg.